Good afternoon, everyone. Keith Johnson, CPA here with a YouTube update of the American Relief Act for March 22nd, 2021. Wanted to share the guidance as it continues to come out on the American Relief Act, which really has worked with people understand the the stimulus payments and maybe the unemployment exemption. Those are probably the two sexiest parts of it. But, the American Relief Act actually will touch people in many other ways as well. So it's important that you understand how it affects you and how it could affect you. So today we're going to examine the Earned Income Credit. Now, the Earned Income Credit is it's been around for decades, and basically what it is, it's a credit, it's a handout for low-income taxpayers, and to be honest, it's been cited by many economists as one of the main reasons for lowering poverty. One of the big ways to fight poverty is the Earned Income Credit. It's targeted. You're basically, in order to qualify, you have to have pretty low income and have children, although it's not a deal breaker if you don't. And having that helps. To be honest, I think it's better than a lot of these social safety net programs, but I digress. Anyway, the Earned Income Credit up until this year has been basically for families with low incomes. Now, if you have children, your income requirements are much higher, your upper limits are much higher, and your the amount that you can receive is much higher as well. If you did not have any children, that's okay, but generally the most you're going to get is about $400 if the stars line up correctly. So the ARA does quite a bit for the to improve the generosity of the Earned Income Credit. So first off, the Earned Income Credit age up until now, it's been 25 to 65. Okay, so if you're younger than 25, you didn't qualify because the theory was you were in college or still living with your parents. If you were over 65, then the theory is that you're on Medicare and Social Security, so you really don't need it. Okay, that's changed. Okay, also a good thing is that it's a prospective credit rather than a retroactive credit like some other ones. In other words, it's not going to take effect until the 2021 tax year, which will be filed next year. And there'll be some stuff that you can use for that. But anyway, so what's happening is, first, the minimum age is being dropped substantially, so that in order to qualify for the Earned Income Credit, you have to be at least 19. And however, there are some exceptions to that rule too. If you are 18 but were classified, you spent some of your childhood at homeless or in a foster home, then you could start qualifying for EIC at that time. Now, if you are a student, the age was dropped, but not as low. It's 24 now. So if you're a student, you can start claiming it at 24. Now, the maximum age of 65 is now waived. So you don't claim, you don't have to be a certain age now. So if you are still working in your 70s, you qualify. However, keep in mind that it's called the Earned Income Credit, so that because of that, you have to have earned income, hence earned income credit. So you have to do that. So that's important. Now, there's some other things in the past or that were passed too. For instance, generally, as with all credits, if you are married filing separately, you didn't get the credit. And generally, married filing separate is really the least favorable tax status that you can have. Basically, you're giving up all your credits: your child tax credit, child care credit, earned income credit, premium tax credit, all of that. Well, here they are now saying in certain circumstances. Now, we didn't see how they've been defined yet, but for certain separated people, they can get the EIC. Another thing was that the phase outs for the various number of children were increased, and usually it's a sliding scale, and they adjust it every year. So used to be if you didn't have any kids, to qualify for the earned income credit, your maximum income is about $14,000. If you have one child, it tends to be about 41, 42. And if you have more than one child, it's closer to 55,000. So, but those phase out ranges are going to be increased. So if you have higher income and you think you make too much for it, you might want to re-examine it. Also, the limit on investment income has been increased substantially. Now, in past years, the amount of investment income, the maximum amount that you could claim and still get some credit, was $2,200. Reason being is that, this was to lock people out of the EIC if they were just like living off their investments, which is fine if you could do it. But, the government didn't want people, just living off their parents' money and, just having it go into their bank accounts, take a part-time job just to do something rather than twiddle their thumbs and all that. So they said, no, if you have more than $2,200 in investment income, that knocks you out of the EIC. Starting in 2021, that amount goes up to $10,000. So the most you can get from investment income in 2021 is $10,000 and qualify for the EIC. Also, final goodie in this part of the package is that if you, depending on what your income is going to be for 2020 or 2021, you can elect to use the 2019 income instead of your 2021 income when claiming the credit. Theory being is that, your income, if, maybe you lost your job in 2019, and there were people that did. Of course, this was before the virus. There were some people that did, and, now they're working and, they want, but if they work now, they may not qualify. So that's why they're allowing them to use a prior year. Now, I think this is a one-year thing, but it is out there. So you can elect, if you're in that situation, to use 2019's income as your base rather than 2021. As I said, it's a prospective credit. It's not going to take effect until, it's in effect now, but you're not going to be able to claim it until next year's tax return. So it'll reduce the confusion somewhat that the IRS and all the tax software companies are going through. So tomorrow we will look at another part of the not earned income credit, but American Relief Act. we will probably be looking at another one of the credits, maybe like the child care credit or child tax credit, excuse me. And we'll do that. So anyway, y'all be safe and take care, and we will see you tomorrow. And please let me know if you have any questions, and please subscribe. Take care. Bye.